Mike Maloney is all about the gold-silver ratio. I mean, literally, he talks about it every single day. This is Brian Lewis with MMT Investing, and things just changed. So we get the basic idea of the gold-silver ratio, which is the wider that ratio gets between silver and gold, eventually it will come back together and be good for silver. So I have a look at the S&P line down here. Let's grab some gold and draw a gold line. Oh no, I don't want to turn that one. I want a new line. Yeah. So what gold has been doing is pulling down also with the crashes and then bouncing, pulling down with the crashes and then bouncing. And gold's actually up right now. And this main line is the silver SLV. And the bottom line is the S&P, the top line is gold. So let's take a look at what is actually happening between gold and silver and the stock market, and then also the gold and silver ratio always smashes that like button right now to help me out with the YouTube algorithm. So what is actually happening here during this crash, and we'll take a look at this crash and future crashes. So in this crash, we have gold doing interesting things. Gold pulls down when the stock market pulls down, and that's because gold is like money, and you have to use your money. You have to sell it in order to pay for your stock market losses. But then gold is bouncing way back up. So gold looks like money that is gaining value over the course of the crash right now. And silver is sort of money, sort of a commodity, and it's pulling down with the crash. Silver's this middle line. It's pulling down with the crash and bouncing a little bit, pulling down with the crash and bouncing a little bit. So it's not pulling down as far as the S&P is pulling down, but it's also bouncing up at the same angle as the S&P. So silver looks like money that is losing value during this crash. So that makes silver pretty boring right now. For the next month and a half, it looks like it's just gonna kind of trickle down. It's just gonna head down a little bit to the end of the crash, and gold will kind of head up to the end of the crash. So what does this mean for the gold silver ratio during the crash? Well, it looks to me like it's going to separate farther during the course of this crash. So the general idea for the crash is that we have a 3-month credit cyclicalization, a 3-month credit cycle, which is a contraction down cycle that does a general bouncing behavior usually. And so for the rest of this cycle, where we get a down and a bounce and a consolidation kind of move on the S&P here, I should probably do that one in red. Where'd my brush go? Okay. So the S&P looks like it's going to bounce down and then do another bounce and a consolidation, sort of movement like that. And silver looks like it would do... No, a new brush. Silver looks like it's going to do a little bit less deep of a down movement, and then a similar kind of move up, and then a less deep of a down movement, and then that's what silver looks like to me for the rest of this crash. And then gold looks like it is gonna do a similar kind of pull down, but much bigger bounces up, similar pull down, bigger bounces up. So over the course of the crash, the gold silver ratio looks to me like it is going to be notably wider at the end of the crash, the gold silver ratio is going to be wider. And gold is effectively a good long and a much better long if you buy it at the bottoms. And silver is just a boring kind of bear through this crash. And then if we go out into a longer term bear market, it's gonna look something like 3 months of recovery, and then maybe like 2 years down of a bear market. So the recovery would probably bring the ratio slightly closer together over the following 3 months. But the bear market would probably keep the ratio either the same or wider over the next 3 years. So that's my outlook on the gold silver ratio, is that silver looks like a bear for the next month and a half, and then it could be okay. I think silver could be okay for the following 3 months here. I think silver is better than gold here for the next 3 months here. So gold is good on the ups, on the S&P ups here, here, here. Silver is going to be good after we get out of the credit contraction cycle and we go into positive territory. It should be better than gold here. Silver should be better than gold here. But I don't know if silver or gold is going to be the best move in an expansion. I mean, then you want to look at tech or something. And then on the longer term bear market afterwards, I think the silver gold ratio is just going to get even worse. That's what it looks like, because gold over the bear market is just going to go up a little bit for 2-3 years, and silver over the bear market is going to just kind of go sideways-ish or down. So silver should come up here, and then it should just be kind of sideways or down, kind of boring. And I would expect that the gold-silver ratio hits its max at the end of that 2 to 3 month or 2 to 3 year. I think the gold-silver ratio will be at its max out here in 2.5 years somewhere in like 2023 maybe. You'll get your max gold-silver ratio out here, and then that is exactly where silver becomes awesome. Then silver starts coming back to gold in the market, and then gold probably would start coming down there. So this is a really long-term outlook of gold and silver, how they react to the stock market during a credit contraction cycle, what they're going to do over the following 3 months in an expansion phase, and then if we get a longer-term bear market, that doesn't really help silver, and the bear market will definitely help gold, and it will not help silver. Silver could be sideways or down. That's the idea of gold and silver over the next week, the next month and a half, the next 4 months. It's gold is ups during the contraction cycle here. You do gold on the ups, gold up, gold up, gold up. But you don't want to hold any of these things on the S&P downs because they go down with the S&P. And then here, I think gold and silver are both boring on when we reverse out of this credit contraction cycle, because it's an expansion. That's not good it's not good financial conditions or market conditions for monetary metals. And then a longer term bear market is probably going to widen the gold silver ratio and be better for gold than silver. And then here, after we get to a long-term bear market bottom in 2 or 3 years, then silver looks really good. And I've noted this is probably where housing bottoms also. Housing will probably bottom here. Silver will probably bottom here. and then gold will probably top here out at the end of a long-term bear market. That is what I think. That is a lot of lines and squiggles. I hope that was easy to follow along. Please hit the like button to help me out with the YouTube algorithm. And then, oh, also, this is the SLV chart that I'm looking at here. And I wanted to mention that the SLV is relatively safe ETF. It's with JP Morgan, who is a solvent bank right now and is a primary dealer bank, first in line for bailouts from the Fed. They also have 50% of the world monetary silver vaulted themselves. So I'm not scared of holding on to the SLV, but the GLD is really scary. GLD, the custodian of the GLD is HSBC, which is one of the big international banks. Like Deutsche Bank and HSBC are the banks that are in trouble in this financial crisis. Those are the international banks that are failing right now. This is an international monetary crisis crash that we're in the middle of. HSBC and Deutsche Bank are in trouble. The Fed has opened a new repo market called FEMA to try to get money to them. They're doing it this week. And HSBC as a custodian of your GLD ETF is just scary, just straight up scary. Now, this is not financial advice. Look this stuff up on your own. This is just what I'm trading and what I'm doing. So I am happy to hold SLV, and I will not touch GLD, not even on the short moves. There are other options besides those two ETFs. There's some gold trusts. There's the Sprott Gold Trust, which is what is it? Physical, PYSL. I think. Anyways, the Sprott Gold Trust, PHYS is Sprott Gold, and it's a gold trust vaulted in Canada and has way less counterparty risk than the GLD, and that's the gold trust that I'll be trading on the ups. And then they also have a PSLV trust, the Sprott Silver Trust, which is probably similar counterparty risk to the SLV. Just a heads up on actually trading them. And then, of course, if you have physical gold, you are your own counterparty risk. You have to you have to physically keep people from stealing it. But then you don't have any of the banks as custodians and all that stuff. So everyone recommends physical gold and silver so that you actually have it in hand if you need it. And I don't know if that's always true because you can't trade it if you have it in your house in a vault, for one. Yeah, and two, I mean, if people know you have gold or silver, they might come and rob you. So it's not as safe as people say it is. And then also something. Also smash that like button. What was I thinking of? Yeah, I can't remember. I had a third point and it just disappeared. It was so important, I thought. So the gold and silver ETFs are a decent trading option because you can trade them intermittently. You can day trade and swing trade them, and that's important because, as you can see, gold is super interesting to trade, and it's a winning long, but you don't want to hold it. You want to trade it on the ups during this crash. So you definitely can't trade physical gold on the ups during a crash. Like it's a long-term hold kind of thing if you're stockpiling gold. But like over the entire course of a long bear market here, holding physical gold would be really cool. And the third point that I was trying to make is the counterparty risk. So I mean, if you have like $100 of gold or $1,000 of gold, like keeping that at your house isn't super scary. But I mean, say you had like $1 million or $10 million worth of gold, like you definitely don't want to have that sitting around the house. At that point, you'd want to be looking for different countries and different jurisdictions to vault your gold in, so you can lower your political risk in different countries. And you have to look at the companies in those countries and see if they're good gold vaults. And there's a lot of considerations if you're trying to keep a lot of gold over a long period of time. So there's a lot of options for how to hold gold and how to trade it. But gold, I'm bullish gold for a long time here. Bullish gold on the ups right now, and then bullish gold for 3 years after this cycle. And silver looks just kind of blah. I don't like it short term. I don't like it here. I don't like silver for the next 3 years. I don't care about it. I was looking into silver a ton last year and trying to figure things out, and now we get to see how it behaves in these market conditions, and I just don't really like it that much. And I've also noted in another video that Bitcoin is sort of acting like silver. And then we saw that treasuries are acting a lot like gold. So it looks like right now, from what the market is saying, it looks like gold and treasuries are money. And it looks like silver and Bitcoin are not money right now. Like they just are not behaving like money in the market. So gold and treasuries are money. If you're thinking about money, gold and treasuries are very similar to holding dollars, except dollars you lose money to inflation. And with gold and with treasuries, you have either interest helping you or you have upside. So it's like cash with upside. That is the idea. And I don't know what we have here. This looks like maybe like an alligator. So happy trading.